Welcome to the Dividend Talk podcast, episode 38. Our thoughts about different popular valuation metrics. Hey guys, welcome back to another episode of Dividend Talk. I'm your co-host, Engineer My Freedom, and today I'm joined with EuropeanDGI. This is a podcast where we discuss our passion for dividend growth investing with our own unique European flavour. If you're new to this channel, please hit the like button and subscribe to us, and check out our previous episodes on YouTube and Spotify. See you on the inside. Hola, EuropeanDGI. How have you been this week?
Really good. Finally, I got to relax a little bit after earnings season. I mean, I know there were some growth stocks this week, but I don't care too much about those. So it was so relaxing. I could focus a bit now on my analysis to look back at some of the companies that were reporting earnings and to get some inspiration about companies I want to further analyze and write about on my blog. So it was actually quite relaxing, but I'm wondering if it was the same for you.
Yeah, it was a busy couple of weeks, wasn't it, with all these earnings? But I'm pretty much the same. I'm starting to filter through my portfolio. I started with Coca-Cola, so I wrote about them this week. Ended up selling them, but you can see why if you want to read my blog post. But I'm just going to try and do that for all my portfolio and weed out the companies that I don't want. But it was definitely a more relaxing week. I felt like I had so much free time when I came home from work. I really did not know what to do. So it was nice. Hey, but it's been quite a proud week for both of us this week. We hit 1,000 downloads over 1,000 downloads in a week. I'm quite chuffed about that.
Yeah, and this was pure podcast, right? Because we have also something on YouTube. So these were pure numbers, not the total numbers. And yeah, it's just really funny to see, right? How we started last year, just talking a little bit about dividend stocks, recorded ourselves, threw it on the internet, and now there's quite an audience and a really engaged audience. This is actually what makes me most proud.
Yeah, we do get a lot of engagement on Twitter, but I realize not everybody is on Twitter. So we are available on Facebook and also email. It's dividendtalk@gmail.com. So any questions, or even if you just want to chat, just feel free to contact us on any of the platforms. And we both really enjoy it and we love it. So feel free to reach out. So I'm just going to jump straight to the point here. And I believe a lot of people have been waiting for this, but you've done it again. You send out a tweet and a CEO resigns. How do you sleep at night? How do you feel about this?
I feel totally fine about this. It's really simple in this case. So for the listeners, what I did after the dividend cut from Danone, I tagged the CEO from Danone, Emanuel Fabel. I guess he will be listening actually today because it will be part of his personal development plan. But I tagged him on Twitter and I asked him, like, why did he do this? Because I was clueless. And I did this before also with the former CEO of Intel. And literally both CEOs and the only CEOs that I ever tagged like that resigned or got fired. So there was, all jokes aside, this is of course just coincidence. But it is fun to see, right? And in this case, he resigned himself. It was his proposition. I learned, and when I read through the analysis, is that there are some active investors there that are really demanding change. I think it's good. I feel a bit sorry for the person from that point of view, because what I really like about the CEO from Danone is that he has really the stakeholder mindset, wants to do good for the world, also in his product line. And that's why they have such a nice product line now. Yeah, that's why they have all this plant-based stuff, which I really see as the future. I just think that at a certain moment, what you see of an organization itself as well, sometimes you just need a new fresh wind, someone with new ideas. And I can only say that I have respect for a CEO that comes to the conclusion themselves that it might be a better role for someone else to try it. I think he still stays being the chairman, but not the CEO anymore. So
Yeah.
actually, I have a bit of respect for that. That he resigns, I think, is a good thing. He cut the dividend with 8%, so I believe you're not totally sane then anymore. Whatever good strategy you have behind it.
Yeah.
Yeah.
Look, I'm not sure it was the dividend cut that that made him resign. But he did mention, and I've said that when you read the annual report, that the share price is not where it should be, and I believe investors were probably putting a bit of pressure on him because of that. I mean, investors want to see a return
Yeah.
on their investment, and they weren't seeing that in price appreciation, which is more typical of what European investors may want. So he was under a lot of pressure in that sense. But he did look, he did make some good reforms. I think it was a shame he stepped down. I don't think he performed too badly. I would have liked to see him continue for a little bit. So no, best of luck to him. And it's untypical, isn't it, for kind of a French guy or a French company to do something like this?
Yeah, that's where my respect comes from. Yeah, that he actually does it. I don't know if he had a gun on his head. Of course, I was not the fly in the wall in the room there.
Was it your gun?
No. But honestly, how I look at it, EMF, the CEO get massive pay packages, and I believe we may demand more from them.
Of course.
Yeah, than what we as simple foot soldiers on the work floor do. So from that point of view, and I mean, we should not forget, right? I think Danone was one of the first companies last year that where all the whole board said we hand in a quite large amount of our bonus and everything. So I think the ethics in this board are really I think exemplary to many other boards that we know in the world. So, but in the end, I'm a shareholder and I demand. I said, I just demand more out of it than what they have been giving, and I like this strategy now, going back to local. But yeah, maybe they need another guy now just to try it. He can always come back if needed.
Yeah. He's still there, so I'm sure he'll still be offering his advice and guiding whoever comes in. We have some questions on that later. I was going to ask them now, but we'll keep them for later on.
Good.
You have some more news, I believe, on Chamath.
Yes. So Chamath Palihapitiya. He sold his personal stake in Virgin Galactic. It's this company from Richard Branson as well where they merged and via a SPAC deal.
Mm-hmm.
This company was really up a lot, 160% this year already, and now it's almost back to its price as per 1 January. And that's because Chamath sold his personal stake in the company. So they still own a lot with social capital. The news item or the press release said that he is selling this so that he can allocate this money to a new deal that he's doing. And I understand this, but I find it really interesting then how the stock prices respond to that, how the market respond to that. So what it tells me that Chamath himself is like Katie Wood. If they put somewhere their money, then they have such a large following that really drives really strong volatility in the share price. And I find this amazing to see how many people are in it only because of him.
Yeah.
Although his company is still in Virgin Galactic, so that's also really interesting.
Yeah, his company's still in there, but if you're following him and you see a large sell-off like that, automatically it would trigger you to sell as well, wouldn't it? Because if he's getting out, it means he's made his money. There's better returns somewhere else, and that's why he's getting out. So why would you stay in there?
Well, because you believe in the business.
Yeah, but if you're following a company purely based on this guy, you might not.
I know they're not, of course. Yeah. I'm not such kind of investor from that point
No,
of
no,
view.
no, me neither. But you do see lots of like the Katie Woods. You do see lots of people investing purely because these
Yeah,
guys are doing it. So when they get out,
yeah,
then naturally you're going to get out of the market, and it's gonna
yeah,
cause a sell off. So
yeah, yeah. I have that only when you are buying something that I think like, should I buy it as well? But other than that, I don't have that.
don't follow me.
Yeah, and then another news item, and which I found really interesting because, of course, there were a lot of red days for some people on the stock market this week. I saw a lot of it on my timeline about people losing 15% on a day, 10% on a day. So in those days, I'm really happy to be a dividend investor because I had a green day from that point of view because I've got massive oil still in my portfolio. So, I had a big smile on my face, of course. But the reason behind it, why this was all happening, was because of the US Treasury yield going up to 1.5%. And that's quite a news because, people cannot see that, but in our prep, I put the chart there. In December 2018, it was still 3%. Then at 2020, January, it was around 1.75%. And then with COVID-19, it went to, what is it, 0.60%.
Yeah,
And then all the way back up since this summer, since August, right? So there's lots of volatility in this treasury yield. Yeah.
and why is that significant? What is the significance of that?
So how I understand the market, right? If what the market effectively is saying is like, screw you, Powell. You can think whatever you want, but we think inflation is coming. So this means that we demand more from the US Treasury yields, and then you get this inverted, because what's important when you consider inflation and such and the US Treasury yield, it has an impact on the how you say it, on the cost of capital in the market, because it then also becomes more expensive to for instance to sell bonds. The market will demand a higher return from you in percentage wise, which means then if you start using a valuation criteria, which we are talking about today, like a discounted cash flow, which I think half of the market runs on, and it suddenly doubles compared to 2-3 months ago, your cost of capital will increase. So your weighted average cost of capital, which means that if you discount that with your future earnings, let's say your future cash flow, it's just less worth than what it was 2 weeks ago. Hence, you want to pay less for a company.
Yeah,
And the impact is even better if you go from almost zero to 1.5, right? Because the impact, it's almost, how do you call that? Such a long tail formula, right? If the US Treasury yield is at zero, you can pay almost anything, yeah, with free money. So the first part of the hike really puts pressure on the stock prices, specifically the high growth ones that are highly valued.
yeah. No, it's interesting, and I think Powell, they've targeted inflation of about 2%. Is it 2 or 3%?
Yeah,
So they want it to rise slightly, and we can certainly see that going to be happening soon. It's not going to be good for some of our companies that are in debt at the minute. Like,
yeah.
if interest rates are going to rise this quickly, people are going to struggle, I think.
Yeah, but it won't get to 5 or 6% that quickly. So I see this more as a gap recovery from where it was before COVID. So, and it almost closed the gap then when it's at 2%. So yeah.
It might put the brakes on the Fed printing money for a little bit as well.
Yeah, and I would be really happy because then, how I see it, prices might go even more down when there's less stimulus. And this is this kind of dilemma, right? That's now popping up. The market is disagreeing, so that can have adverse effects. But realty income went to $58 or $59. Well, I wouldn't mind buying some already at these prices. But let it go to 55, and I definitely buy few again. Yeah, so I'm actually happy with it because the dividend yield just increases for us, which means we get more dividends for the same buck. So.
Yeah. Perfect. I think that leads nicely then into our topic, where we're just going to discuss some of the popular valuation methods. Some of them I use, some of them I don't use, but it's nice to know what's out there. So we might talk the basic one first. First one that everyone kind of uses, which is the PE ratio. So do you want to explain to our listeners in basic terms what a PE ratio is?
Well, it's just a multiple of the annual earnings. So the price to earnings, right? So if a company earns let's say €3, and you have a price to earnings of 20, that means the stock price is at that moment then at €60. Yeah, and there is kind of a rule of thumb that many dividend investors use, that you shall not pay more than 20 times the earnings for a company, because otherwise it's overvalued. It's kind of I said, a rule of thumb. Yeah.
Unwritten rule, so to speak, with dividend companies. But to be honest, it's not something I follow at all. And at the moment, we've got valuations above 20 or well below 20. I personally like to check against the industry and see what the industry average is doing, and base it off that. I mean, comparing, I don't know, someone like Walgreens, which has a low PE ratio, to a Microsoft, which is a high PE ratio. How can you put a valuation of 20 on both companies in different sectors? It doesn't make sense to me, really.
Well, actually, I fully understand what you say, but I often do look at it, because from the other side, you could say like, okay, it takes 20 years to get to the earnings, right? It's quite a lot, 20. So if you then suddenly have a price to earnings of 30, and that's the weakness of this PE ratio, because you're not taking growth into account, earnings growth. But if it is then for a slow growing stock at 30 PE, it's for me something that usually I already disconnect from or disengage from. Of course, the weakness in this number is as well that the earnings might be having a one-off, for instance, an impairment or something like that, which makes the earnings really, really low. And you see this, for instance, with cyclicals, like an oil company.
Yeah.
When it's going really well, the PE is how you say it, really low. But when it's going really bad, it's terrible. But actually, the best time to buy them when it's bad. Yeah. So.
Yeah, but I think this is a good starting point for most people when coming up with some sort of valuation. It gives you an average of where the company is at, really.
Yeah.
But
it gives you a feeling. That's what
yeah,
it is. Yeah.
Yeah, it gives you a feeling. That's a good way of putting it.
And then we have also the next one is the price to book ratio, the famous one that Warren Buffett was always promoting.
Yeah, where he looks at the equity, which is equity is basically the book value. It's the assets minus the liabilities, and then he gets the book value per share, and then divides that by the price. I think I said that right. So I don't use this a whole lot, because I find, say for example, I was looking at Coca-Cola, for example, this week. I mean, they have a lot of intangible assets and stuff, so their branding and goodwill, and this doesn't give a reflection on that. So they have a negative price to book value, for example. So I kind of swerve this one a little bit. I do look at it, but I don't give it too much notice. It's not for all industries. I'd imagine the oil sector is probably a tough one for this one as well.
Yeah. So why I never use it, because I believe it's quite popular when evaluating banks and such, because there it makes more sense, right? If you look at the assets, and I don't buy banks. And Buffett really liked it because his company was always cash rich. It's really asset rich. I think it is one of the most tangible assets in the world as a company, Berkshire. So then it makes a bit more sense. But I also know that he stepped away from it because, for instance, if you're buying back shares, your equity also goes lower because of your treasury stock. So with the financial engineering and such, it becomes also much more harder to get a reliable value out of it.
Yeah, I think you hit the nail on the head. It's more for an asset-rich company. It's maybe likes of Google and stuff like that are really, really asset rich, but I don't find it a really good indicator for most companies.
Yeah. And how do you what do you think then about the next valuation metric, the price to sales?
Again, it's not another one that I use a whole lot. It relies a lot more obviously on the sales and revenue, but again that can vary. So I don't think I've ever used price of sales. Don't think I've ever used it.
So I know it's popular to use it when you have early growth companies that are not making profits yet, because then the price to earnings makes no sense, as an example. And then what I always understood that is price to sales makes much more sense to use it because it's a more reliable figure at that moment. And I said you can also better compare it with other companies at that moment in time. Yeah, because that's what, to your point of industry comparison, that's where it really helps at the time.
Okay. Yeah, I mean, probably better for startup companies. Looking at that,
Yeah.
which look, we invest in mature companies that have been around a long time. I prefer to use earnings over sales in this case.
I think it's good to share this specifically with our listeners that are new to dividend investing, that if you go to Morningstar and you see all these ratios, after 6 years of dividend investing, like we mentioned, for me, PE and probably price to free cash flow as well makes some sense, but price to book and price to sales, I typically skip them straight away. Those are not values I look at Morningstar. They are nice that they are there, but they don't have meaning for me.
Yeah, I'm the same. I look at them. I look at price to book sometimes. I might compare to the industry, but I don't pay any attention to it. So in my template that I use, that I share, you'll see that I use a dividend cash flow, dividend discount model, and the PE ratio. I get the average of each. And that's pretty much what I use to value. But we mentioned PE ratio, and it has a downfall that it doesn't take into consideration the growth. But there is one metric that does that, and that's the PEG ratio.
Mm-hmm. So this one I actually use quite often, not a lot, but often. And because what it really does is it's the PE divided by its growth, right? So let's assume that your price to earnings is 15 and the company is growing also with 15. Then you have a PEG of 15% earnings, right? Future earnings, estimated earnings, let's say. Then you have a PEG of 1. And the rule of thumb is like under 1, it is undervalued. Between 1 and 2, you could still consider it for a good business, but when it's over 2, it's usually too rich valued. And I like this metric a lot because if you think about one of the metrics that is available on the web quite easily without any effort, without any analysis, I like this one the most because it really quickly tells me that there's growth behind this company. And it makes it also easier when, for instance, if you look at the PE, to your point earlier, when it's 25, and then the company is growing with 20% earnings, expected to grow, then it's attractive, right? So I really like that ratio for that reason.
Do you know what growth rate it takes? Is it 1 year or 5 years, or?
I believe it's the 1 year, if I remember correctly. Yeah.
Okay.
And this is based on the analyst forecasts and everything.
Yeah. So I mean, it's a little bit short-sighted in that respect because growth rates can fluctuate, but it's still a good metric. I actually found a really good website today on that by a guy called Aswat Damodaran, I think his name is. It's an incredible website. He has tons and tons
He's the
and tons.
master of valuation, I think.
Yeah, it's incredible. I've only came across him today, and I just before we came on air, I watched 2 videos. He's incredible, but he has a resource there, and it has every company. It has all these growth rates. I'm probably going to get lost in that website this weekend. We'll post a link in this description, and I recommend checking it out. But his videos that I've watched are top class, and his
Yeah, I believe he's a professor at New York
Yes.
University, and he's often on CNBC where they interview him, and they call him the master of valuation. And I remember Wolf was always quite a big fan of him.
Yeah, I don't know how I haven't come across him before. Maybe I haven't. I don't remember. But when I was getting lost in all the valuation, all the Excel spreadsheets he has. Literally has everything, and you can
Yeah,
download it, and it's for free. He doesn't ask you for an
yeah,
email address. Doesn't ask you for anything. Just all they are, take it and use it, and it's pretty good. So
because his salary is paid by the students in the tax office, so he better make it for free indeed.
hey, he could earn a few quid if he really wanted to. It's
That's true.
it's impressive stuff. But we'll put it in the link below, and I would say check it out.
Okay, so then now let's look at the next one, which we already start to calculate ourselves a little bit. And next one will be the dividend discount model. And I know you've used it also a few times. Could you elaborate a little bit on what it is and what you use it for?
Yeah, so we're pretty much looking at the future cost of dividends based on the value now, what it'll be into the future is what we're looking at. Yeah, so one of the things that you have to do with this discount model is you have to estimate a couple of things, and you have to estimate the dividend growth rate, what the cost of capital will be, and then your expected dividend per share. So this opens it up to a little bit of discrepancy. So depending on what you feel or what inputs you put into this will determine how accurate it is. So I find it a really good way of valuing a company, but it does rely a lot on your inputs and what you personally think will happen with the growth rates.
Yeah, and the sensitivity is really strong, right? So if you, for instance, have a cost of capital of 7.5% or 8%, it has already a really large impact on the fair value price of the company. So, but what the good thing is, you can get these numbers from, for instance, stockanalysis.net website as an example. So we can put the link in the in the description as well. Often you can get the data there, and sometimes they do this calculation already for you as well.
Yeah, Finbox uses it as well, and there's plenty of websites out there that will do it for you. But again, it's all depending on what you put into it and how accurate it will be. And to follow on from that, then what about the discounted cash flow?
Yeah, that's actually my favorite one, probably because I'm having an analytical mind. What the discounted cash flow is, and literally the words say it already, these are the cash flows that are discounted to the price from today. So the future cash flows, let's say the future 10 years of cash flows, you can estimate them, discounted to the price of today, because money in the future is less worth compared to the money that it is today, if you consider, for instance, inflation. Now, this is where we come back to the cost of capital again. So a typical number for cost of capital in an interest environment that we have now is 8%, right? I would argue that around 2007, it was probably 10%. So if you believe that every dollar, therefore, that you have today gets 8% less worth for you, so next year will be 92 cents because of your cost of capital is 8%. Yeah, that means that a dollar 10 years from now is really worth much less. And that's how you're looking at the sum of cash flows in the future. So what you can do, let's say that your cash flow now is 100 million, your free cash flow, and you think that it will grow with, I don't know, with 10% or something like that, and then you have a cost of capital of 8%, maybe it's then 102 million worth next year. I'm doing this from my head, not using a template. Now, but then you can take the 100, the 102, and so on for the next 10 years. And then you sum that all up, you get a number out of that. But then you assume that this is for 10 years. But there is also still like an assumption there that, hey, there's still cash flow for the next maybe few decades. What you then typically do is what you call a terminal multiple. So you say like, okay, in the company then will be still like, let's say we're 15 times the cash flow in year 10. Yeah, if you want to purchase that company. So what you do then is you sum the 10 years of cash flow plus the multiple of 15 times the cash flow, and then you get a number out of that. And that number is your intrinsic value of the company. And you divide that by the amount of shares that are outstanding, and you get the fair value price of an individual share. I think it will sound really complicated, and it is not easy because you really need to know what you're doing. But I think that there are a few components that are really important, and that's the free cash flow that you estimate, the growth rates that you estimate. And I would always recommend to not use, for instance, a growth rate into eternity. Just think about the first 5 years that maybe you think 5-6% growth, and then it goes to 2% growth, like almost like a bond or inflation related. I would recommend that for, let's say, consumer staples and such. And then you have also your cost of capital, or also called the discount rate. Those are the most important factors. I would say those factors in itself are a little bit less sensitive than the dividend discount model. That's why I prefer the discounted cash flow model. And the discounted cash flow model allows me really to take my thoughts about the business into consideration. So if I think that the business now still has like 2 or 3 years of exceptional growth ahead of them because of a catalyst, but then it will die down again because the market is saturated, you can all put that in the dividend in discounted cash flow formula. That's why I like it. And yeah, I will soon, not today yet, but I will soon put also my template on there on my website so people can find it later as well, or people can just ping me to get it. But I think you have also a template for that, so they can also go to your website to grab it if they're interested.
Yeah. And we have one last one to speak about, and I think this might be the most popular with some of our colleagues out there, but it's the dividend yield.
Yeah, we should not forget that, because I think many people make buying decisions based on the dividend yield, right? We're dividend investors. So for me, for instance, a company below 2.75% yield should really have something special for me to consider it. Yeah, so if you think then from a valuation point of view, yeah, probably I'm more interested in companies that are valued in such a way that they give me a dividend yield of 2.75%.
Yeah, I look for kind of 1.5 times the S&P 500. That's what I look for. But it's easy to get caught up in this. If you look at someone like AT&T, for example, with a 7% yield, it's easy to feel that they are undervalued at that price. But then if you run a dividend or discounted cash flow on them, you will probably find that they're not undervalued.
Yeah.
They're probably fairly valued or overvalued.
Yeah, and that's probably good, really, what I actually forgot to mention about the discounted cash flow model, because you need to subtract it with all the debt and add the cash on hand to it.
Yeah.
And a company like AT&T looks usually really poor after that compared to others. Yeah, you're right.
Yeah.
So what I would just say, like we discussed now, I think 7 or 8 metrics. I think 6 out of them I consider in my analysis. So it's not, I never focus on a single metric by itself. I look at the PE, I look at the price to free cash flow, I look at the PEC ratio, I look at the dividend discount model, I look at the discounted cash flow, and I look at the dividend yield. And if most of them are in red, it's a no buy. Even if my favorite one, the discounted cash flow, still tells me it's undervalued.
Yeah, I'm the same, but I only use 3 of them. I only use the cash flow, the discount model, and the PE ratio. But like that, if one of them is green and telling me to buy, it's not enough. I need it across more than one just to confirm my own thesis. And what I usually do is I give myself a margin of safety. So because I make so many assumptions with the dividend discount model and the discounted cash flow, I'm not a world-class accountant. I'm probably going to make mistakes, so I usually give myself like a 10, or depending on the company, maybe a 10 or 15% margin, and
Yeah.
then that's what I consider then as a fair value.
Yeah, definitely. I do the same. Yeah. Good. Well, I hope that the listeners found this useful. I hope for some of it was not too complex or too simple. Just give us feedback if that's the case. We'll adjust our level of speaking then for the next podcast. But maybe there's now a more nice time to go to the listeners' questions of this week.
Yeah, I wonder who's first on the list.
Must be Phil, right? Yeah.
You know it. You know it.
Yeah.
So his first question is a good one. He asks us, which incoming dividend payment do you normally cherish the most?
The Unilever one, just because I love this company. I really like it. I just really like always that Unilever comes in, makes me just puts a smile on my face. No clue why. Otherwise, it's awkward. But it's a really nice question because I think everyone has this with some emotion to a certain stock.
Yeah, mine is the same as Phil's actually. It's realty income. It's just every month, bang, 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 it's there. You know it's coming, and I don't know. It's something about a monthly paying stock just makes me smile every time I get the dividend. Makes me smile. I'm still really irritated that I can't buy them on the Gyro, by the way, and I haven't got a concrete answer. But it's the one company that I just know it's going to be there every month, and I love it. So
Cool.
yeah. I think the next question is for you, and Dividend Wave has asked a similar question, so we'll tie both of them in. But which CEO do you want to see next resigning?
And this is related with the two tweets, right?
Yeah,
So at the moment, I don't have any strong candidate. There's nobody that annoyed me enough to get on Twitter again and to tag them. So I know that there are shivers growing through Wall Street, and that the whole Wall Street is listening to this podcast because they're all nervous. But if you're listening and you're a CEO, you're getting a pass from me this week. But no, honestly, if there's one CEO that I think needs to step up and has a last chance to do a better job as CEO of IBM, he's half a year in the job now, I think. It's Arvind Krishna. I mean, I mentioned already before in this podcast, it's a declining business. His predecessor made a big mess out of it. And I have a feeling that he's just not, I don't know what he's doing there. When I listen to him, I fall asleep. He's now doing a spin-off, which there's nothing that excites me. There's just nothing that excites me at all when I hear him talking. So if I have this already, I think like, what about their 100,000 employees? What are they thinking? If you have such a leader that I don't know. I mean, he looks like a painting. Yeah, nothing. It just sits and watches. So for me, I think he needs a strong personal development plan and start getting some, I don't know, some, how do you say it, some sex in him or something like that, some energy in him. Yeah.
If I was Alan Jope, I think the Unilever CEO.
Yeah.
If I was him, I'd feel a little bit under pressure because it's the company you love the most, and if he slips up, he could be next out the door.
Oh yeah, true.
And how about John Stanky of ATT? How do you feel he's doing?
Well, what I really appreciate about him is that he's actually just selling all the crap that he has inherited. And yes, he's doing this at bargain prices. But what I like about him is a little bit like Mr. Culp from General Electric. They got such a mess handed over that, and if I now look at what's his name, Larry Culp or from GE, I think this guy is doing really great, and I have a similar feeling about Stanky a little bit. I mean, I'm really not happy with AT&T with the shareholder wealth destruction that they have done. However, the Stanky, at least he's doing something, right? He's making up his mind. He's doubling down on HBO, is active in 5G. Of course, he has to. But I don't see this guy buying another DirecTV or what is it, Blockbuster or something like that. That's really what I don't see him doing. If he does anything, it's probably something stupid more that he goes into the satellite business. But at least then it's like forward looking, not backward looking. So for me, no, he's actually doing a good job, and I just would like to see that he's not fooling us as shareholders with shouting that they I don't know, was decrease the debt while the debt went up. That's just pure lying. You shouldn't do that anymore, and we should maybe just send him a message, like a direct message saying like, Stanky, nice guys, but don't fool us. Yeah.
Yeah, it's interesting to hear you say that he sold DirecTV. He more basically gave it away.
Yeah, he gave it away. Yeah, but
Gave it
maybe
away.
maybe that was even the best, because the alternative was that he had to put money with it. And so,
Mm.
yeah.
So I just did a quick Google here while we were chatting of the 5 worst run companies of 2020. Can you guess the 5 of them?
No.
Okay, first one, AT&T, John Stankey. Second one, Intel, Bob Swan when he was
Yeah.
there. The third one is Ford, James D. Farley.
Yeah.
Then we have IBM. So we
Yeah.
have Arvind Krishna. Then we have Macy's, Jeff Gennett. So I mean, three out of 5 we picked there.
Yeah. So, we would almost start to believe in ourselves. Come on, we're just bloody retail investors reading some annual statements from time to time, looking them up on YouTube. I mean, we're rather stalkers than investors when it comes to the CEOs. So.
Exactly. Great questions, and probably expected this week, based on the events of your tweets.
Yeah. But hey, who knows? Maybe Stanky is next. Anyway. Let's go to the next question from Dividend in Czech, our German friend. And he asked, I recently saw a video from Ian Loppuch about the speculation strategy. Do you also own more speculative stocks, assets, or do you focus exclusively on dividend stocks?
So recently, I've started to trade a little bit in foreign exchange. So I always have this itch to trade. Always had it. And I've started recently. There's an Irish guy called Michael Horton, and he has a podcast called the Irish Fire Podcast, and he has a few blogs, and he's a great guy. I've been chatting to him quite a bit. But he started up this new website called Treaty FX, where he guides you through the basics of foreign exchange, and he also shows you how you can copy trading. And there's actually an Irish guy runs Black Wave Capital. He manages nearly 3 million in that, and you can copy his trades, or it does it automatically for you. So it's a good way to learn. You can put in whatever. I have a small amount of money in. It's a good way for me to learn, but also scratch that little itch of trading. So that's what I'm doing. I'm not comfortable in picking growth stocks. I'm not comfortable in any of that, but I do want to trade. So I've been toying a little bit with options and trading other stocks. I'm using interactive brokers for that, but I'm more focusing on FX at the minute because it's more fast paced, and I want to learn it. So that's where my speculation is. But I've said a small amount of money in that. It's purely for fun. I mean, I don't mind if it crashes and burns. It's more of a learning experiment for me. But dividend investing will be my main strategy.
Yeah. So I think I responded to this already before on other podcasts, but I have 10% of my portfolio allocated to what I call the mad money section. But believe me, I don't believe that Facebook, Google, and Alibaba are mad money. So, but this is for me speculation. It's still value investing, I would say. I think they are fairly valued. But sometimes I do it. Sometimes I buy something little just to try it out. But I mean that's then we're talking not even about a tenth of a percent. So not speculation, but I do invest in some non-dividend paying stocks like Facebook and such that I just mentioned.
Yeah, from an Irish perspective, this This is probably a more important question because I don't know if you read Wolf of Harcourt Street's latest blog post and where he changed his strategy away from dividend stocks. And he's in a higher tax bracket. And because of that, he can pay up to 52% in taxes on dividends. So it's quite difficult. I'm not in that situation because my wife doesn't work and we can lower our threshold and spread it out. So from an Irish perspective, dividend stocks might not always be the best case, but I've already explained before ETFs follow a similar route. So the tax is quite heavy. So that lends it down to the road of buying companies to hold like a growth stock.
Yeah.
But again, that's difficult for me. So that's why I stick to dividend investing. If I was to pay 52%, I'd have to rethink that a little bit. But it's part of the reason I want to learn how to trade. And if I could make 3 or 4% a month off that, I'd be quite happy.
Yeah, definitely. Good. Thank you. Good question. Then we have Tommy. He asked, what do we think about Leggett and Platt Inc. Incorporated?
Do you know what? I'll be honest. It's one of these companies that I always see pop up, but I never really look into them, or I've never had the urge to actually look into them a little bit more.
Yeah. So I for me the same. I always see it passing by, but also to give Tommy an answer to if I will pull it through my dividend screener, it actually looks quite good because it has 49 years of dividend growth, which is for me really a dividend aristocrat. And I think 50 years it becomes a dividend king, and there are only a few companies in that list.
Yeah.
It also spots currently a yield of around 3.5%, which I think is actually quite a good yield. And if I look at the business that they are in, so it manufactures and designs and produces all kinds of engineering components that you find in homes, offices, and automobiles. So it sounds like a boring business. 49 years of dividend growth. So it passes my criteria for my dividend stock screener. So I'm actually thankful that Tommy shared it with me, and maybe I should start looking in it a little bit because I like boring companies like that.
Boring companies is what we love. Hey, I'm always amazed at people that know every single stock. Do you know what I mean? Every company they know about it. I don't know how people do this. I struggle with my portfolio, let alone adding in hundreds of other companies. So,
well, let's do this podcast for another 5 years with so many listeners asking these great questions. I think we'll double our knowledge about stocks.
certainly, and I look forward to you writing a post maybe on these.
Yeah.
Sweet. So we have a question from Arose Detum. I think that's how you pronounce it. But he asked us, if there's a 20 or 30% pullback in the market, will you do anything special? A lot of people talk about consolidation of portfolio. What do you think about that?
So I don't know what consolidation of portfolio means, but I can tell you what I will be doing. I will be taking the key of my war chest, open it up, and I will be doubling or even tripling my monthly investment into all these great stocks. Imagine that I think Johnson & Johnson is around $150, that it would trade around $100. Wow. I mean, wow. I will be buying as much as I can Johnson & Johnson at that time. So I will be a really, really big buyer. My war chest will be fully open, and I will be spending like crazy. That's what I will be doing.
I believe consolidation, he's talking about balancing maybe your portfolio. I'd imagine that's what it means.
So yeah, because the balance would be in like doubling down in my tier 1 stocks. Yeah, so there are 10 stocks in my tier 1 category. For instance, I would also like to love to own some Starbucks and Nike, specifically Nike, but it's always so bloody expensive. But if it comes down 30%, but I think Nike would come back in such a pullback around 50%, I would be for the first time initiating a position in Nike. I mean, it would be for me almost a dream come true that it happens. So but I will focus on my tier 1 stocks because those are the ones that are so foundational to my retirement portfolio. I will make sure that I use such an opportunity for strengthening that foundation.
Visa might be one that I'd be interested in if it dropped 30%. they always seem like they're overvalued, and I really like them as a company. So I would love to add them. I know that they have a low starting yield, but I'd love to add them on a drop. But I'm the same as you. If it drops 20 or 30%, I'm going to be going all in as much as I can. We've seen from the last drop that we had in March, it's easy to say this, but when the time comes, you can see a lot of shaky hands, and it's hard because you don't know when the bottom will be. It could still drop another 20% after that, but certainly if we see a large drawdown, a large pullback, I'm ready to unload.
The psychology is really hard at that time, but last year I told myself, do it. Don't get afraid, and I did it. And I mean, if I look at those purchases that I did last year, like Chubb, Johnson & Johnson at $115, those were really, I mean, I was buying there in March, April around the bottom quite a lot. So I really benefited from that. Yeah. It was a good learning because it built my confidence that it was the right thing to do.
Yeah, certainly. Okay, and his second question then is, how often do you make buys in 1 month?
Yeah, usually once or twice. It depends on whether the savings that I get from my salary, let's say, I pay myself first, right? Whether I want to put it all in one stock or in 2 stocks at the same time. But usually and you know, to do more than 2 makes no sense for me because I pay still commissions on the shares, and the commissions just become too high to consider smaller purchases.
Yeah, I'm saying 1 or 2 because of the fees. Even though the fees are quite small on the gyro, I still prefer to pay as little as possible. So usually 1, maybe 2 if I'm in 2 minds, but that's the most.
Yeah. And then Tony has the last question. He asked, "What financial media do you read, and what would you recommend to others?"
Yeah, I use Bloomberg, Reuters, and Seeking Alpha. Although Seeking Alpha not as much, since they have this paywall up.
Yeah,
but they're the 3 that I typically use.
So I read most CNBC because I have my portfolio in there in the mobile app. And then you can see all the news that is related to an individual stock. What I also like about CNBC, they have all these little videos about where they're commenting on a certain company. So I can then see, for instance, on a company that I own, I see, for instance, few pundits responding to it. And of course, these pundits, they might have totally different investment strategies, but that's why I like CNBC. But to your point, this is usually quick news, quick bites. If I want to know a little bit more, I sometimes buy the Financial Times.
Yeah.
But then I buy it in paper copies that I can read it from home, just because it's more study material. And for the rest, actually after CNBC, my biggest financial media are just the investor relation pages that I'm, roaming around on. So, yeah.
One magazine I do buy occasionally is The Economist.
Yes, it's also a good one.
Which when I used to travel quite a bit, I pick it up in the airport all the time.
Yeah, me too.
Since lockdown, I haven't actually bought it. I was actually thinking about that the other day. I miss buying it, but then that's because I probably miss traveling. So
yeah,
but it's another good one to add to the list.
Yeah. Okay, so thank you all for all your questions. As you could hear, we're quite passionate about answering them. Let's go then to the last section, and let's introduce the stock pick again, because last time we had so many stocks to discuss that we thought like, okay, that was a bit enough. But now in this case, I would like to talk about consolidated Edison. I wrote a blog post this week about my watch list, where it was also part of. And why I'm writing this, why I'm bringing this one up is because Red Electrica, the Spanish utility, cut its dividend by 5%, and they're also committing less of their dividends in the upcoming years. They put a bottom in place, which is less than what it is today. So for me, I want to get rid at a certain moment of Red Electrica and replace it with another utility. Then I did my stock screener, and I came out on consolidated Edison, which is one of the largest utilities in the United States, with a majority of its operation in the state of New York, and it mainly distributes electricity and gas. It has already 47 years of dividend growth. So like the other company that we just, Leggett and Platt, that we did before, also again a massive dividend aristocrat. And it currently yields around 4.5%, which is quite decent for a utility. It is trading around its 5-year lows, and their 5-year annual dividend growth rate is around 3%. So, and this is what you can expect from a utility. We talked about valuation metrics, a PE of around price to earnings of around 17 at the moment. I find this company interesting. There's a lot going on in the States at the moment. Phil asked me also today about it, like, what do you think now that the people are fleeing New York City to out of the city to go live somewhere else? I think that this might be a reason why the share price is down. I've not studied enough, full disclaimer here, to understand why it's at its 5-year lows, because I'm talking about this. I'm recommending a stock pick because it passed my screener. I didn't do a full due diligence on all the flags that I see. And when a company is a 5-year low, there is always a flag for me that I need to study further. But if it is the hypothesis that people are fleeing New York City and going elsewhere, well, New York State is quite big, so I don't see that as a too bearish case for this company. So for me, it's a company that I'm going to study further in the upcoming weeks, and that's why I'm sharing it today, because from a screener point of view, it checks all the marks and looks really interesting.
That's a strange one with the people leaving New York. My sister lives over there, and I speak with her regularly, and she has never mentioned that in the slightest. It still seems to be as busy as ever and people around. So I haven't heard too much on that front, but if it's true, it'll certainly be interesting. But I mean, there's 14 million people in New York.
Yeah. But he's right. Phil's right. It is in the news, and there are 2 states: Californians, rich people going to Texas, and in New York City. But what I heard that's that they are more escaping the city.
Yeah.
Not necessarily escaping the state, but for me, New York is so special. It's the financial hub in the world. It will always attract people, and it will always attract wealth. I just can't imagine New York losing wealth. And I know that there are some New York people in the media that went to Florida because of favorable tax environment and such. But there's so much money going through New York. I can't see that this will impact Consolidated Edison. Yeah, still these high frequency trader need servers, and they will need electricity. So yeah.
No, it's a good company to look into. I mean, they don't own the power grid, or do they part own? They just distribute electricity and gas, is it?
Yeah, but with that you also own the assets, right? When you distribute. So, for instance, I said the power plants and such, which I said turn it into electricity and such. So usually such companies, for instance, they get the energy from certain sources, like a brown coal factory or something like that, or a wind farm. And that's where the connection comes to a utility company, because they then get this kind of electricity in their own current, right? They transform it into the right current that you can distribute, and then they distribute it to the homes. But usually you see then when it comes close to the homes, there's a last mile company or a small utility bringing it to the homes. So
That's do you know what? That's a pretty good explanation. I was laughing away here. I'm electrical engineer, so it's right in my field. But you explained that quite simplistic in a nice way. It was really good, actually.
cool. Having said that, I think we came to the end of the show again. I mean, time flies. It's amazing.
Yeah, I can't believe that. It felt like it was only 5 or 6 minutes. So it's after flying.
Yeah. Good. Well, thank you everyone for staying so long with us. We wish you all a really Good weekend. Of course, if you have some time on hands, leave us this review on Apple Podcasts. It really helps us out. Thank you for that. And once again, we mentioned it before in the show. Drop us just an email if you're not on Twitter. Just drop us an email. So it's dividendtalk@gmail.com. And we might be able to answer your question in the upcoming podcast. Have a good weekend, all.